Hey guys, Brett here with Numbers Up Finance. It's Thursday, December 20th. We're midday right now, about 12:30 p.m. Eastern Standard Time. Scary day. We see this red stick here so far for the day. I'm looking at SPY right now on the daily charts. SPY is the SPX 500. It's a it's a diverse, it includes all 11 sectors of the market. It's probably the best representative of the market as a whole, where it's going. I follow the Nasdaq just because there's more volatility, more risk reward. SPY here is definitely better representative of the market as a whole, just because of its diversity, things along those lines. Just a little bit less volatility here, as you see. That's not gonna show you. If we go from the top to the bottom here, we just see about 16%, where in the Nasdaq right now we're at about 20%. Anyways, I want to take a look here at SPY today. We already broke well below our 2018 lows, and today we moved all the way to 248 and even broke that line of support. Now, 248, I'll go back to the weekly chart for you guys. 248 is the last line. There's really not a lot of price zones here of any significance. This is kind of, that's a toughie. Maybe I could see one right here, but you see we're already well past that with the 2018 lows. But there's really just no points of consolidation, or very weak consolidation between, 2016, 2017 area. Anyways, so here's the first line we had resistance here back in 2017, and we met that line and passed it right away. As you can see, that wick, is passed right through. So moral of the story: SPY, the S&P 500 is dipping down at a scary rate. I want to look at the MACD as well. We see the MACD, it did make a lower low than this previous low here at this peak. So again, that weakens the case for the bullish divergence. But there's still potential that the MACD turns before this point. So we still would see bullish divergence as prices make lower lows, but the MACD momentum oscillator makes higher lows. Anyways, just wanted to keep that in mind, that the SPY is already well past the 2018 lows, whereas we look at QQQ, which I've been following, the Nasdaq 100. This is what I've been trading. It has yet to reach those annual lows. They're just below that 150 mark, and we cut just shy of it today. In the QQQ, or in the Nasdaq, we still have this bullish divergence playing out. This momentum line, the MACD line, hasn't turned upwards yet, but it at least hasn't passed this previous bump here. That leaves for a strong bullish divergence left to play out if the market does turn anytime soon. It has been frustrating seeing all these indicators and signs that the market is due to turn bullish. In the past few days, it has been frustrating to be stopped out. But again, that's just the nature of the beast. As long as you are correctly sizing your positions, minimalizing your losses, paying close attention to those stop losses, having them set at good levels, at very cautious levels, conservative levels, you're going to prevent loss of money. You want to minimize drawdown. Losing money is a hell of a lot worse than gaining money is good, if that makes sense. Anyway, there's still plenty of potential risk reward wise if the market is to turn bullish anytime soon. The case for a bullish run is getting a little bit weaker and weaker and weaker as the prices fall. Again, technical analysis is not a perfect system, just because this seems to be indicating a bullish trend reversal does not mean it has to happen. Nothing is 100%. But at least just from my intuition, I believe a lot of this current selling, this is panic selling. This is selling out of fear, especially being so close to the recent hike in the Fed. Nothing's going to be that predictable. Last thing I wanted to touch on, when we look at our last correction here at the beginning of 2018, we see it ended with this green candle. It's called a whipsaw candle. The bottom of the wick here, there's a tremendous intraday spike down before the candle normalizes, and the candle closed up here between these two price levels. That candle is what indicated the end of that correction, and then we see growth from there on out. Again, we can see a whipsaw candle right here, which ended this little mini correction. We even see a whipsaw candle here, sort of thing. So a green candle like that, with that large wicks to either side of this large wick downwards, that could be indicative of the trend reversal. So pay attention to that. As you can see, we are definitely going to be building a giant wick here, and the price on Qs keeps moving up. I'm really going to be paying attention to that closing price. If I see Qs moving through any line of resistance here, with some authority, with with a little bit of impulsiveness, I think that would be my target to buy back in. Close at the 154, I'd be a little bit indifferent as to whether it goes down or up from there. It's a line of resistance, and it was just underneath it, so typically you'd think you'd bounce off resistance. But again, I'm really not that much so in favor of a bearish run yet. So that's about all I have today for this midday cap. Now is the time to be paying attention. Now is the potential to be, buying into longs with both fists. If this candle, does turn green, or if this candle even turns flat, or very close to flat, depending where trading normalizes by the end of the day. Closed prices are the most significant prices, in my mind. Here is the potential for plenty of growth. Here's the tip. The highest peak so far since our correction has started. We got about 15% growth possibility if we return to highs. I wouldn't discuss probability. That's just an idea. There's 17% growth there. Having bought at the bottom, see growth of almost 19%. That's a fall of 19%, but in the future that would be a growth of 24%. A little confusing how that works, but if you think about it, it makes sense. Moral of the story, though, another important thing, the fact that this has only fallen, it's shy of 20%. 20% is what's indicative of a bear market. I think the fact that we've fallen short of an official bear market, I think that also could be potentially a strong sign for the bullish case. The market's not ready to go officially bear. That would indicate the reversal here. So just pay attention. It's definitely a good case for a bull run here. Also a very scary case for a long-term bear run. Definitely a time to be cautious, but it's definitely going to be a good time to rely on technical analysis here in the near future as trading starts to normalize after that spike in the Fed. Can't let your hopes down because of these consistent long red candles. Again, that is very likely, in my eyes at least. I would draw it up to impulsiveness, panic selling. It's a scary time in the market. Big 20% drop. We haven't seen something like this, in the last 10 years since 2008 crash. So, time to pay attention. But definitely a lot of potential for growth. Manage your losses, and you should be fine. I think that's all I have for now. Pay attention to these close prices before the market ends, 4 o'clock. And I think that's all I want to touch up on. So, good luck trading. Get your numbers up. And if you like this video, like, comment, subscribe. Thanks.